But even in real dollar price terms, silver would probably be $100, $200 right now just to match those highs. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. All these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country.
The financial world is on the edge of a
You're watching
cliff,
Silver
and no
News
one's
Daily.
ready for
Subscribe
what
for
comes
more.
next. Momentum expert Michael Oliver just dropped a bombshell that's shaking the foundation of modern finance. A full collapse of the US dollar, the complete dismantling of the Federal Reserve, and silver exploding to levels we've never seen in history. He's not just talking about a price rally. He's calling for a reset of the entire system. Forget $20 silver. Forget even $50. Oliver says the real number is between $200 and $400. Because this time, it's not just about inflation, it's about trust. And that trust is gone. In his words, this is a crisis that is not print-awayable. And if he's right, we're standing on the edge of the greatest monetary shift since 1971, when the dollar was cut loose from gold. The Fed, the dollar, and the entire fiat illusion? It's crumbling. And in its place, a return to real, honest money. Gold is already surging toward $8,000, but silver, the most misunderstood asset in the entire market, is the one that's about to leave everything else in the dust. The system is breaking. The clock is ticking. And the window to act is narrowing by the day.
If you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro-technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar, dollar has not been a factor, the dollar index, when you measure versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015, when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further win for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Silver has finally broken free, and the world hasn't caught on yet. For over a decade, it's been trapped below $30, dismissed as a relic of the past while gold stole the spotlight. But that's over. In mid-2025, silver shattered the $40 barrier for the first time in more than 10 years, and it's not stopping. As of now, it's hovering around $43, with momentum building by the day. This isn't just a price breakout, it's a psychological one. The $35 and $40 resistance levels, once seen as immovable walls, have been crushed. The charts are flashing bullish signals across the board. RSI is sitting just below overbought, MACD has turned green, and the 200-day moving average is sloping upward for the first time in years. The breakout is real, and for those paying attention, it's a wake-up call. But what's driving this sudden surge? It's not just retail FOMO. Institutional money is quietly pouring in. COMEX open interest has jumped 15% since June. Major funds are rotating out of bloated equities and into tangible assets. And silver, with its dual role as both a monetary metal and an industrial powerhouse, is finally being re-rated. Analysts at CPM Group are already forecasting $50 to $55 by mid-2026, while others say $60 is conservative. And if a real crisis unfolds, if the dollar continues its slide, or if geopolitical tensions flare, $70 becomes more than just a target. It becomes inevitable. This isn't just another silver rally. It's the beginning of something much bigger, a catch-up move years in the making. And now that the dam has broken, the rush has only just begun.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly, like 3 times. It got up to 3,500 or 3,450. Right now, we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it, and they kept getting these $100, $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So
gold is lighting the fuse, but silver is the one strapped to the rocket. While silver's breakout above $40 is impressive, it's what gold is doing that could make this move historic. As of September 2025, gold is charging toward $3,500, with calls from veteran analysts pushing targets as high as $8,000 in the event of a full-blown monetary panic. And here's the catch. Silver doesn't just follow gold. It exaggerates gold's every move. Always has. In 1980, gold peaked just above $800. But silver? It soared to $50. In 2011, gold hit $1,900, and silver again surged to $49. When gold runs, silver doesn't walk, it sprints. And this time, the setup is even more explosive. Why? Because gold's rally isn't being driven by excitement. It's being driven by fear. Fear of inflation, fear of geopolitical instability, fear of monetary collapse. Central banks are hoarding gold at record levels, quietly dumping treasuries while loading up on physical bullion. They know what's coming. And as the flight to safety accelerates, the spillover into silver becomes inevitable. But silver isn't just riding gold's coattails. It's dramatically undervalued in comparison. The gold-to-silver ratio is still sitting around 82 to 1, far above historical norms, which means silver is priced as if gold's move is just a fluke. But if gold hits $8,000, even a modest reversion to the historical 50 to 1 ratio implies silver at $160. And that's without factoring in silver's industrial or inflation-adjusted tailwinds. This is what Michael Oliver means by a catch-up rally. Gold is already halfway up the mountain, and silver is just starting to climb. But if the panic escalates, if confidence in fiat erodes even faster than expected, silver won't just catch up. It will explode past expectations, just like it always does. And by the time the headlines catch on, it'll already be too late.
I think anybody who pays attention to those old highs as if they're important is illusory. Okay, it's for the reasons you just described. First off, they're ancient, and and look around you at the other base metal, copper, gold miners now. And why is silver? It's a dog? No, it's not. It's just been overlooked, and investors quite often do that. They make mistakes. They underprice things, they overprice things. In the case of silver, it's vastly underpriced. We're also watching something that very few people look at. We keep the spread between gold and silver. The way we do it is we divide an ounce of silver to an ounce of gold and express it as a percent. Silver recently got a pullback low that was slightly below 1% of the price of gold. Well, in our weekend report, we showed going back to 1975, what was the highest reading that silver-gold spread reached in each of those years? And 20 of those 50 years, it reached at least 2%. Okay? And in bull trends, like 79 to 80, 2010 to 11, silver was at 3.5% to 6%, the price of gold. Okay? Right now, we're, above 1%, and we're pushing up, toward 1.2%. Not far above here, when we run momentum of the spread chart, we're going to get a breakout. And when we get that, we expect the spread to also break out. Now, there's a level on the spread at 1.31%. What's that? Over the last 5 years or so, there have been 2 rally highs in the spread that halted at that level. You ever clear that, it's a horizontal range breakout for the spread. And historically, if you go back and look at this performance of that relative performance of silver to gold, whenever silver's beating gold, is surging upward, that converts into net price upside in both metals, meaning silver doesn't outperform gold because gold goes down more than silver. It's always silver outperform gold when they're both going up. Get the point? So while everybody's looking at price, we're also looking at the spread, and it's about to engage in a major breakout as well. And when it does, I think that spread is at minimum.
The gold-silver ratio is flashing red, and it's not a warning, it's an opportunity. Right now, gold trades at roughly $3,500 an ounce, while silver sits around $43. That's a ratio of 82 to 1, meaning it takes 82 ounces of silver to equal 1 ounce of gold. 82 ounces of silver to equal the value of a single ounce of gold. Historically, that number hovers closer to 50 to 1, and in previous bull markets, it's collapsed to 30 to 1 or even lower. What that tells us is simple. Silver is dramatically undervalued relative to gold, and when that ratio reverts, it doesn't happen slowly. It happens violently. We've seen it before. In 2011, the ratio plunged from 70 to 1 to under 35 to 1 in less than 12 months, triggering a silver price explosion that nearly hit $50. And that was during a much more stable monetary environment. Today, we're dealing with record debt, fading central bank credibility, and a global push away from fiat currency systems. If gold continues to rise, or even just holds steady near these highs, and the ratio compresses back to 50 to 1, we're looking at $70 silver. But a drop to 40 to 1? That's $87. And in a panic scenario where silver reaches even 3% of gold's price, you're staring at triple-digit silver in plain sight. This ratio isn't just a number. It's a reflection of investor psychology. Right now, the market is still anchored to old assumptions, pricing silver like it's stuck in 2015. But as momentum builds and money rotates out of collapsing fiat and into real assets, that mindset is shifting. Silver ETFs have seen 20% quarterly inflows, outpacing gold for the first time in years. The world is waking up to silver's potential, and once that ratio starts collapsing, it'll be the biggest tell that silver's time has arrived and the real move is underway.
I think silver is likely between now and the year end, and maybe sooner than that, take out its old dual highs at 50. First off, they're phantom highs, meaning when we were there before, it was very brief anyway, like hours or a few days before it collapsed. But even in real dollar price terms, adjusting for the degradation in the money unit, which goes and increases in supply about 90% every decade, silver would probably be 100, 200 bucks right now just to match those highs. Okay. And then put it another way. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. Now, what do I mean by lag? Look at copper. It's above its 2011 high. Gold, well above its 2011 high. Gold miners on Friday, XAU blew out its 2011 highs. GDX made a new high monthly close. Not above the intra-month highs of 2011, but a new high monthly close. And silver's at 40. Okay, 42, we're almost today. I think silver's going to do a big catch-up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge point. Okay, not that it's going to peak there, but that we're going to blast through those old nominal highs and not even pause until we get credibly out above them. And then maybe you get a correction of some kind, not the end of the bull. But I think that's what we're facing right now. So yeah, momentum said, back in early June, watch out, I'm going to blow out the dual highs at 35. October of last year, March of this year, we dropped all the way down to under 28 in that period of time. And when we came back up through 34, got up to the upper 34s again, momentum said, you're gone, you're going to take off. And I think it's only just begun.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
Silver's breakout isn't just a monetary story. It's being powered by something far more tangible: industrial demand. In 2025, over half of all silver consumption, roughly 55%, is being driven not by investors or central banks, but by real-world industries that simply cannot function without it. This isn't speculation, it's necessity. And that necessity is growing fast. The solar sector alone now accounts for 15% of global silver demand, and that figure is climbing as governments double down on renewable energy mandates. Silver's unique conductivity makes it irreplaceable in high-efficiency photovoltaic cells. No silver, no solar. It's that simple. But solar is just the beginning. Electric vehicles are ramping up globally, and every single EV requires silver in its battery systems, power inverters, and charging infrastructure. Then there's 5G, semiconductors, aerospace, and even medical tech, all of them increasingly dependent on silver. And as AI-driven automation expands, the need for faster, more efficient electronic components is accelerating the demand even further. Unlike other precious metals, silver isn't hoarded in vaults. It gets used, and once it's in a product, it's gone for good. It's not easily recycled, not easily recovered, and not easily replaced. Here's where things get dangerous. While demand is surging, supply is not. Global mine production is stagnating. Silver has now been in a supply deficit for 4 consecutive years. And with miners facing rising energy costs, stricter environmental regulations, and a lack of new discoveries, there's no easy fix on the horizon. This imbalance, soaring industrial use versus constrained supply, is the silent force lifting the floor under silver's price. Even without a financial meltdown, even without the Fed unraveling, this alone could justify $60 to $80 silver over the next 12 to 18 months. But if monetary chaos hits on top of this, then silver's rise becomes not just logical, it becomes unstoppable.
Yeah, I think a lot of people think of Trump as free market, and I don't think of him that way. He's very interventionist in a lot of things, not merely government agencies, but, send troops here, send troops there, do this, then change it and do that. Tariffs here. Tariffs are taxes, after all. They get passed along in the process. And some people recognize that, even people on the right who used to be Republicans and now are no longer part of the Trump party. And even JD, Trump likes also to print money. Back, before COVID even hit, he was talking about we need to cut rates below the Europeans and get them to zero. Because why? We should have cheaper bonds than they do in terms of the interest rate. We shouldn't have to pay so much for service our debt. And so he told the Fed then, but he didn't do anything about it. Fed later did cut rates to near zero. But anyway, the point, he's still talking that way. I want rates at 1%. Well, and that's not a market pricing of an essential commodity. That's a government edict. And so naturally, he wants to control the Fed to control that aspect of the economy. Well, I mean, Mussolini would have liked that too. Pardon me for saying that, but that was his view of his adaptation to socialism. Wasn't we nationalize companies and so forth, but we control them from above without seizing them. And we control money and so forth. And Vance, though, the other day made an interesting statement. He said, why should we have a group of academicians determining the price of money? In other words, he was questioning intellectually the even existence of a Federal Reserve, which a few libertarians have done, but now even the VP mentioned it. Now, Trump hasn't because he'd like to control it, get rates down. But these are the kind of changes I'm talking about. What will cause them? Events, trends, and pain. And if we're correct in our analysis, monetary metals are going up. 2, certain other assets are going down that are bubbles. And also certain other areas will ambush, I think, the average guy. Remember, the guys who voted for Trump were, one, the GOP regulars, but also blue-collar workers who said, hey, he's going to keep prices down, particularly gasoline prices. And this year we saw lower prices. Well, that wasn't because of Trump. That's because oil has been under pressure and so have commodities. But our technical analysis of the commodity category, and particularly crude oil, is that you can't sneeze on the upside, because if you do, you're coming up out of here big. There's going to be a whole nother commodity upwave, like we saw between late 2020 and 2022 when commodities doubled. Still at low levels on the Bloomberg when it did double, but it doubled. And I think we are in a technical situation where that's one of those ambush events that will help cause doubt and pain. Because when you're pumping the gas and all of a sudden it's 50% more than you paid 6 months ago, because oil goes from, we've got a major breakout starting next quarter at $68. Well, we're trading 64 plus right now. You go up $3 or $4 more between now and next quarter. In next quarter, that's going to be a breakout level. And oil's going to surge. And I'm not going to explain why, because I don't know why. Don't care. But technically it says I'm going up. And the Bloomberg Commodity Index is in the same position. So again, here's an event that could occur. It's likely to occur in our assessment. And when it does, it's going to be an upset factor, meaning emotion. It's when you get the emotion in the game, that's when all of a sudden hands go in the air and you look.
Now let's talk about inflation, the silent thief that's making silver look like the most undervalued asset on the planet. Back in 2011, silver touched $50 during a brief mania. But if you adjust that number for inflation using the US CPI, that $50 would be worth around $70 today. And that's the low-end estimate. When you factor in broader monetary expansion, like the 90% growth in M2 money supply over the last decade, you start seeing targets that make 100 silver look conservative. Some analysts are now calling for $150 to $200 as the real inflation-adjusted ceiling. So while silver currently trades around $43, it's not just lagging, it's still less than half its inflation-adjusted peak. That's not just undervaluation, that's a glaring mispricing, and it's not going unnoticed. Savvy investors are ditching bonds and fiat-denominated assets, opting instead for what they call honest money, real, tangible stores of value that can't be debased by a printing press. Gold has already been the primary beneficiary of this shift, but silver is still early in the revaluation process. It's why the price-to-inflation-adjusted high ratio for silver remains stuck at 0.61, while gold sits closer to 0.95. The disconnect is massive, and it's closing fast. Here's the bigger picture. Inflation isn't going away. With governments addicted to spending and central banks boxed into a corner, currency debasement is no longer a risk, it's the policy. That means anything tethered to real value, especially silver, becomes a political act. Holding silver isn't just a hedge, it's a rejection of fiat. It's a stand against debt-fueled economic insanity. And as more investors wake up to this reality, silver's inflation-adjusted breakout becomes not just possible, but inevitable.
Does not have a bubble situation. They may go down with us, but they don't have a bubble. But it will cause real-world, in-the-street consequences where certain things that we all take for granted, but really have only been around this century, one very long human lifetime, such as central banks controlling what money is. Why should you have a government monopoly over the most essential commodity of human interaction? Money. Okay, it's as if government controlled the price of corn, determined how much is going to be produced each year and what its price is. Well, we would call that socialism, right? Okay, which it, would be. Well, what controlling the most essential commodity in human interaction, a money unit, is even more manipulative and controlling and less free market than any action they've done. But when that process proves that it doesn't work, and proves it in a way that's painful to too many people, then you have doubt. And not just among the average guy who's hurting, but academicians who look at these institutions and say, hey, this hasn't been working. It's just been this recurring process. Or like Jamie Dimon made a point, a month or so ago about the bond market situation. It's this constant process of the degradation in government debt in relation to its ability to raise the money, et cetera, that it can't go on forever. This time it's going to be different. And we think he's right. I think it's going to be true. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. If events get real dark economically, you may not have income taxes. Why? Because it's simply dysfunctioning. Public can't pay it. And the IRS doesn't function in terms of the percent of revenue it's supposed to bring in. So, they go to sales tax or something. But all these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money.
The Federal Reserve was once seen as the immovable pillar of the financial world. Today, it's a house of cards, swaying in the storm it created. For over a century, the Fed has controlled the dollar through a cycle of rate manipulation, QE, and endless bailouts. But now, the tools no longer work. Interest rate hikes have crushed consumer credit. Debt servicing costs have ballooned past sustainability, and inflation remains stubbornly high. Michael Oliver put it bluntly, this is a crisis that is not print-awayable. The system is bloated, cornered, and losing credibility fast. And when confidence dies, so does the institution behind it. That's why some experts are now seriously floating the idea that the Fed itself could be phased out, or rendered obsolete, by market forces. Sound crazy? Think again. Public trust in the Fed is near historic lows. Critics from both the political left and right are demanding structural reforms. Meanwhile, parallel financial systems are already emerging. Decentralized finance, commodity-backed currencies, and most notably, a surging demand for honest money in the form of gold and silver. These aren't fringe ideas anymore. They're becoming part of the mainstream conversation. In this environment, silver isn't just rising because of supply and demand. It's rising as a statement. It represents everything the fiat system is not: limited, tangible, and outside of central control. As the dollar weakens and faith in central banks erodes, people are turning to assets that don't rely on political promises. And with silver still historically cheap and increasingly symbolic, it's quickly becoming the people's currency in a world starved for something real. If the Fed loses control or collapses entirely, silver won't just go up in price. It'll go up in meaning.
Well, for about 100 years now, we've had the phenomenon of governments excessively pushing the pedal and using money as their tool of survival. Okay. And in the process of decaying the real buying power of their money units, euros, yens, dollars, whatever, such that, what I mean, decaying the value of money. When your granddad built a house, it cost him $4,500. Now it's $450,000. Okay. That's an example of degradation of money over, a span of 100 years. It's created boom-bust cycles. We've seen them. We've seen monetary excess, and then stock market booms, and then stock market peaks and goes down regardless of whether the Fed cuts rates to try to defend it. It goes down anyway. And you get these boom-bust cycles created by monetary excessive flows, lower interest rates than reality would have them. Various monetary policies like QE, which they engaged back in 2008, which is now in their quiver, okay? You break the stock market in a few of the, especially certain arenas that I've been mentioning, including, by the way, the banks look very vulnerable technically, especially as we get into next month. All these events could cause the Fed to go berserk. The question is, will this game, this boom-bust cycle game where they come in and they try to put the fire out by printing a lot more money, buying assets, cutting interest rates below any reality point, will that work again? We argue no, this time it won't. This time the boom-bust will end in something more global and more painful to the average guy than 2008, for example, or the dot-com collapse. This time it's going to be more broadly felt. First off, we have the biggest stock bubble in U.S. history in terms of duration of years upside, the multiple gains in the price of the stock market. NASDAQ 100 went up like 20-fold from its 2009 low over a 15-year period, plus, and S&P went up over 10-fold. There's no bull market in history that matches those dimensions. And when you look at money supply or you look at Fed funds rates, you can say, oh, now I understand why. They printed it higher. Okay. When that breaks, real-world consequences occur. This time, I think they'll be so severe and also global, although we're a prime bubble. Some areas of the world aren't. China, for example.
While the public is just starting to pay attention, institutions have been positioning for months, and the signs of an incoming physical silver squeeze are everywhere. Since June, COMEX silver futures have seen a 15% surge in open interest. ETF inflows are up 20% quarter over quarter. Vault stocks are thinning. The largest dealers are reporting longer wait times and rising premiums for physical delivery. This isn't retail mania. This is the early stage of something far more explosive, a stealth accumulation by deep-pocketed players who know exactly what's coming. Here's why this matters. Silver is one of the smallest markets in the entire financial system. The total value of above-ground investable silver is less than the market cap of a single large-cap tech stock. It takes very little capital to send prices parabolic, especially if a short squeeze erupts. And unlike in 2021's Reddit-driven attempt, this time the fundamentals are aligned. Supply deficits, institutional buying, collapsing trust in fiat, all converging at once. If COMEX inventories are drawn down to critical levels and delivery fails begin, it could trigger a rush to secure physical silver at any price. And that's just the market mechanics. Psychologically, silver is still flying under the radar. Most investors are obsessed with gold, stocks, or crypto. But silver? It's still the forgotten asset, the underdog. That's exactly what makes it so dangerous to ignore. The moment this imbalance becomes public knowledge, when headlines start talking about physical shortages, missed deliveries, or forced settlement in cash, it will be too late. Premiums will spike. Supply will vanish. And the price won't just rise. It'll gap higher in a way that leaves everyone stunned. This isn't just about investment returns anymore. It's about access. And the squeeze may already be underway.
Well, we've had the inflation in the sense that the money growth continues. In fact, they're accelerating. The M2 money supply is making new highs now after a pause. That's an ongoing thing. That's why gold isn't $35, it's $3,500, okay? It's not because of any one single event or commodity inflation. And then, so the inflation really is always there. And that's why gold just keeps, over a period of time, it swings up and down versus that metric, but it's upward, just like the decay in the money units. But in the case of commodities, they don't explain. We showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because of a declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines, and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks.
Silver's rise isn't happening in a vacuum. It's part of a global movement away from the US dollar. For decades, the dollar has been the world's reserve currency, propped up by oil trade dominance, military power, and trust in US institutions. But that trust is crumbling. BRICS nations are openly discussing alternatives. Saudi Arabia just signed trade deals in yuan. Russia and China are clearing transactions in gold. And central banks across the globe are dumping dollars and quietly stockpiling precious metals. What we're witnessing is a worldwide rejection of fiat dependence, and silver is sitting directly in the crosshairs of that transition. This shift isn't just symbolic, it's structural. As countries diversify away from dollar reserves, they're looking for real, tangible assets that can function outside the SWIFT system. Gold has always been the first stop. But silver, with its lower price point, rising demand, and industrial use case, is becoming the secondary reserve metal of choice. It's accessible, liquid, and increasingly respected in sovereign portfolios. And unlike crypto, it doesn't need electricity or internet access to settle transactions. It's hard money in the purest form, and it works, even when systems fail. Meanwhile, U.S. monetary policy has become a weapon used against allies and adversaries alike. That weaponization is now backfiring. Countries are moving to protect themselves, and in doing so, they're pushing the world toward a multipolar monetary system. In that system, silver plays a vital role, not just as an asset, but as a bridge between old world value and new world utility. And as the dollar's grip weakens, silver's influence rises. This isn't just a silver bull market. It's a monetary revolution, and silver is marching right through the front door.
For silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I think it'd go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay, so to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know. Not really.
We are living through the collapse of a system, and silver is the signal. What was once dismissed as a forgotten metal is now the frontline asset in a global revolt against fiat money, central bank control, and economic illusion. From the Fed's credibility crisis to gold's panic-driven surge, from industrial shortages to institutional hoarding, every piece of the puzzle points to one outcome: silver breaking out of its cage and exploding into a full-blown monetary supercycle. This isn't a drill. The gold-silver ratio is compressing, physical supply is evaporating, and inflation-adjusted targets of $150 to $200 no longer sound extreme. They sound overdue. And now, with the dollar in retreat and countries dumping U.S. debt, silver isn't just catching up. It's becoming the cornerstone of what comes next. Whether or not the Federal Reserve survives the year is almost beside the point. The market has already started pricing in its failure. In that vacuum of trust, honest money is taking its place. Silver isn't just rising because of fear. It's rising because people are finally waking up to what has value when everything else breaks. The paper game is coming to an end. And when the dust settles, those who understood silver's role will be standing on the right side of history. If you want to stay ahead of this once-in-a-generation financial reset, make sure to subscribe. And remember, this isn't financial advice. Speak to a professional before making any investment decisions.